guys, today I will be talking about adjusting entries. So what are adjusting entries? Well, the adjusting entries occurs in the general journal due to the accrual basis of accounting. Their purpose is to account for the initial entries that are made or yet to be made. This happens due to the time gap in between the transaction. An adjusting entry influences an account in the statement of financial position and an account in statement of comprehensive income. As discussed previously, the transaction is not instantaneous, meaning that goods and money are not exchanged immediately. There are two types of adjusting entries, called deferrals and accruals. They can be further divided on the basis of whether a person is accounting for revenue or expense. Deferred revenue means being paid for a service or a good that has yet to be performed. Deferred expense means paying for a service or a good before receiving it. Accrued revenue means delivering goods and services in advance. Accrued expense means expenses are incurred, but not yet paid. Now let's explain the timeline of accounts. Let's say Bob is paid for a service he has not yet performed, so initially his cash account and unearned revenue would increase. The unearned revenue is a liability as Bob is obliged to perform the service. After performing the service, his unearned revenue account would be debited and his revenue account would be increased. Bob's customer, on the other hand, is deferring an expense by paying in advance. In the initial entry, his prepaid expense account would increase and cash account would decrease. The prepaid expense is an asset account as the customer is owed a service. After the service is performed, the adjusting entry would show his expense account debited and prepaid expense account is reduced. Notice that cash is only involved in the initial entry but not in the adjusting entry. The timeline of changes in accrued accounts is very different than that of deferred. Adjusting entries are made to account for future entry at the end of the transaction. Now let's say Bob performs a service in advance and is yet to be paid for it. In the adjusting entry, his receivable account and revenue account would both increase. After receiving the payment, his cash account would increase and his receivables account would be credited as he is no longer owed. Bob's customer, on the other hand, is accruing expense. Adjusting entries would show his expense account and payable account increase as he is obliged to pay for the service. After paying for the service, his payable account and cash account would both decrease. Thanks for listening. I hope this was helpful. Best of luck for the final exams.